Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Analysis, May 18th, Pre-Earnings Consolidation. This video presents a direct informational narration of the source document. Okay, let's dive right into this explainer. Looking at the market's activity on Monday, May 18th, equities have officially entered what we'd call a pre-earnings consolidation phase. We saw the S&P and Nasdaq close lower, specifically dragged down by semiconductors and Tesla, while the Dow actually managed a slight gain. The core takeaway here, the market is essentially in a holding pattern right now. Before key earnings are released, investors are showing a distinct reluctance to just make blind bets at these high valuations. Instead, traders are watching oil prices and bond yields like a hawk, while simultaneously waiting for further developments regarding the conflict in the Middle East. Now, oil prices did retreat slightly after an early morning surge, which kind of took the edge off the downward momentum in U.S. equities, but honestly, it just wasn't enough to reverse the overall weakness we're seeing in growth stocks. To break this all down clearly, this explainer is going to follow a highly structured, institutional-grade briefing covering 6 sequential topics derived straight from the document. We'll be walking through macro and geopolitical factors, index technicals and options, the institutional AI infrastructure shift, storage sector constraints, capital rotation in semis and software, and finally, Tesla risks and the overall market outlook. Let's get right to it. Section 1, Macro and Geopolitical Factors. This is absolutely crucial for understanding the immediate geopolitical impact on oil and bonds, specifically moving into the current Middle East negotiations. Looking closely at the exact timeline of these geopolitical developments, Axios is reporting that Iran submitted an updated draft that really only included symbolic tweaks from their previous version. They made absolutely no substantive concessions on their nuclear program. In response, the U.S. president expressed clear dissatisfaction and hinted at stronger actions, including restarting military operations if Iran refuses to change its stance. Then, right around 3 p.m., the indices actually saw a short-term intraday spike. Why? Well, the president announced that a military strike planned against Iran for the following day was being delayed. This was due to the initiation of new, serious negotiations that were requested by Qatar, Saudi Arabia, and the UAE. That said, the U.S. military still remains fully prepared for a full-scale strike if they don't reach an acceptable agreement. On the negotiation front itself, reports came out that Iran proposed conditionally moving its enriched uranium over to Russia instead of the U.S. They'd agree to a long-term freeze of their nuclear program, but they are explicitly refusing to completely dismantle their nuclear facilities. Official Iranian media also released claims, which, by the way, were subsequently denied by U.S. officials, suggesting the U.S. would allow limited nuclear activity under IAEA supervision, unfreeze a quarter of Iranian assets on a phased timeline, and temporarily waive oil sanctions during the talks. Now, these geopolitical tensions are presenting some very specific, severe economic threats. The Iranian Revolutionary Guard has claimed the intent to not only set up toll stations in the Strait of Hormuz, but also the right to charge management fees on all submarine fiber optic cables passing through that strait. To put the financial metrics at risk into perspective, they are frankly staggering. The submarine communication network in the Strait of Hormuz currently carries over $10 trillion in global financial transaction data every single day. If this maritime communication node experiences interference, it could bring direct and indirect losses of tens to hundreds of millions of dollars daily to regional and global economic, financial, and energy supply chains. It's a massive vulnerability. So the crucial point regarding the bond market's reaction centers around a massive bearish bet. We saw the 10-year yield spike intraday before falling back. However, trading volume in the TLT Treasury ETF hit over 3 times its daily average over the past month, and that trading skewed heavily bearish. Notably, one trader purchased 15,000 put option contracts expiring in June with a $75 strike price. This position cost $2 million and represents a highly targeted bet that the TLT will drop another 11% before June 17th. If that happens, it would correlate with the 10-year Treasury yield surging right toward 5%. At the exact same time, capital is aggressively flowing into inflation hedges. Data from Invesco shows that nearly $86 million was injected into the DBC Commodity Index ETF in just a single day. That marks the largest single-day capital inflow we've seen since 2022. It's also really worth noting that this ETF has quietly gained about 43% since the conflict began. It's a clear indicator that the market's demand for inflation hedging tools remains super elevated and has definitely accelerated over the past couple of weeks. Okay, let's transition over to Section 2, Index Technicals and Options, and look at how the options landscape is currently shifting. Here are the precise technical levels for the indices you need to know. The QQQ broke below a pretty steep uptrend line that had been in place since the beginning of the month, but it successfully defended its 10-day moving average, which shows the bulls are still putting up a fight. Index fluctuations are holding that 10-day moving average on pullbacks, with resistance observed near the 5,500 and 7,400 levels. Looking at the options layout, the maximum call wall is currently sitting at 7,500, with a secondary wall right above it at 7,600. On the downside, the strongest support zone lies between 7,300 and 7,280. Crucially, 7,280 is identified as the G flip point. Basically, as long as the index stays above 7,280, the market maintains structural buy-the-dip protection, which makes a severe out-of-control crash pretty unlikely in that specific zone. Now, following the recent options expiration, the market experienced an exact halving of gamma levels. Total net gamma literally plummeted from an all-time high of $1.64 billion straight down to just $753 million. This creates a much thinner market structure going forward, which basically means market movements are going to be less smooth and much more prone to high volatility and really sharp swings. And this thinner market leads us right into the key binary variable for the market right now, Wednesday's Nvidia earnings. Because investors have purchased a massive amount of put options to protect against a potential Nvidia downside shock, the market is sitting on some extreme put ratios. Here's the setup. If the market reacts positively to the earnings, the closing out of those put positions could trigger a severe short squeeze, potentially driving the indices right back up to those 7,500 or 7,600 resistance levels we just talked about. Conversely, if the earnings result in a sell the news event, the market currently lacks sufficient hedging power below current levels to provide support. That means the subsequent drop could be exceedingly sharp. Moving on to Section 3, the institutional AI infrastructure shift. We're going to shift our focus to the institutional level, specifically looking at the Q1 13F disclosures from a prominent AI core researcher. What we're seeing here is an exact portfolio rotation. Compared to the fourth quarter of last year, this institution's largest shift in Q1 was essentially an all-in bet on the AI infrastructure supply chain. They actually reduced their primary hardware giants, the traditional pick-and-shovel leaders. Their positions in Nvidia, Broadcom, AMD, TSMC, and ASML are now very low. Instead, they moved their capital into secondary infrastructure. This includes power generation, specifically focusing on fuel cells and on-site power generation rather than your traditional utilities. It includes storage, where they totally bypass giants like Micron in favor of SNDK, and it includes computing power leasing, where they're opting for new generation contractors and crypto miners that are pivoting to AI data centers rather than sticking with the mega-cap cloud providers like Amazon. Looking closely at the specific dollar amounts for their hedging strategies, the institution purchased put options on major semiconductor stocks like Nvidia, Broadcom, AMD, TSMC, and ASML just to protect their portfolio. But most notably, they completely cleared out $747 million in Intel call options that they were holding in Q4 and retained only about $8.93 million in Intel common stock. By liquidating those calls in Q1, they actually missed out on Intel's massive Q2 surge. That represents a pretty significant missed opportunity, though keeping that common stock did provide them with at least some exposure. Next up is Section 4, Storage Sector Constraints. We're transitioning to the specific fundamental factors impacting the storage sector with our primary focus on Seagate Technology, or STX. So the main catalyst for this sector's recent movement was a statement made by the Seagate CEO at the JP Morgan conference. When he was asked about expanding capacity to meet this surging AI storage demand, the CEO stated flat out that building new factories would take way too long and could ultimately lead to overcapacity. He emphasized that they are prioritizing technological upgrades to improve their current production limits rather than sinking money into investing in brand new physical plants. And those comments triggered a whole cascade of sequential factors. First off, STX shares dropped nearly 7%. The CEO's statements essentially capped the market's expectations of massive AI data center expansion. It created a perceived ceiling on Seagate's growth, regardless of what future demand might look like. Furthermore, this renewed a lot of fears about the deep-rooted cyclical nature of the storage industry, sparking concerns that STX could end up losing market share to competitors like Western Digital and Micron. On top of that, fears of a Samsung strike created real supply chain anxiety for parts that STX heavily relies on. When you combine all of this with rising bond yields compressing multiples for high-valuation tech hardware, it led to a pretty broad downward valuation adjustment across the entire sector. Consequently, SNDK dropped 5.3% and Micron dropped nearly 6%, which was driven fundamentally by profit-taking after some really significant prior price increases. Let's jump into Section 5, Semi and Software Rotation. We're looking at the technical exhaustion observed recently in the broader semiconductor space and the resulting rotation of capital. The PHLX Semiconductor Index, or the SOX, fell 2.5%, with 24 component stocks down and only 6 up, which acted as a major drag on the broader market. The technical reasoning behind this is actually crystal clear. After nearly 8 weeks of frantic, non-stop gains, the weekly RSI for the SOX index was pushed to an extreme level of 93. That signals highly overbought conditions and extreme overcrowding. Basically, to prevent a huge sell-the-news dump, even if Nvidia ends up beating expectations, the market is actively shaking out profit takers right now to lower the overall market expectations and free up some liquidity space ahead of the earnings report. As capital exits the hardware sector for a deep correction, we are seeing a very tactical shift. Defensive capital is rotating right into AI application software stocks that had previously been lagging. A prime example of this is ServiceNow, which surged 8.8% against the broader market trend. Capital is essentially hiding in these software stocks to avoid the intense, high-level volatility in semiconductors, while simultaneously positioning for a potential rebound in software. If Wednesday provides positive signals, the funds that are temporarily parked in software could synchronize with hardware, potentially pushing the AI rally from just isolated hardware gains into a much more systemic, industry-wide expansion. And finally, we introduce our 6th and final section, Tesla Risks and Market Outlook. Let's look at Tesla's specific vulnerabilities and wrap up with the broader market conclusion. Tesla shares have now fallen for 3 consecutive days. Following the news regarding a SpaceX IPO, Tesla's stock came under immediate heavy pressure. Here's the context. For years, Tesla was basically the sole public avenue for retail investors to bet on Elon Musk's vision. But now the structural metrics are being heavily compared. Tesla currently trades at a 195x forward PE, and it's facing slowing sales along with intense competition. On the other side, SpaceX is viewed as having an absolute monopoly in the aerospace and Starlink satellite internet sectors, boasting immense growth potential and almost no direct competitors. The introduction of a more dominant pure-play tech target like SpaceX into the secondary market really threatens to cause a massive withdrawal and redirection of that Musk premium that has long been baked into Tesla's valuation. So what's the bottom line here? Ultimately, the market is undergoing a classic pre-exam risk clearance. Having lost its major gamma protection, the broader index is sitting in a state of narrow consolidation as it searches for support, just waiting for Wednesday's definitive Nvidia earnings to set the directional tone for this next phase of the AI rally. The big question we're left with is this: if earnings fall short, is the market truly prepared for the cascade without its usual downside protection?